Welcome back to the program. This is the Money Talk segment of the program where Dean Areno is going to give us the update on what's going on in the money markets. If you're just tuning in, this is the last segment of the second hour. This is your Real Estate Chalk Talk. We're broadcasting from the Rack Shack Barbecue Studio here in the Twin Cities. I'm Keith Hittner Sr. here in the studio with Keith Hittner Jr. And remember, you can reach us directly at 612-627-8000, 612-627-8000. We can't help you if you don't call, so give us a call today. Dean, what's going on in the money markets?
Well, rates are, since the last show, relatively unchanged this week, even with all of the shakedown with the Fed raising the interest rates. In the end, we settled right about where we were the end of last week. We're hovering right in that low fours, 4.125 range, give or take, for a 30-year conventional. So Wednesday they announced the quarter point interest rate increase, and I think a lot of people, everyone's headline and soundbite oriented these days. I think a lot of people looked at that and said, "Oh, mortgage rates went up a quarter point." Well, what that basically was is that was prime rate. And prime rate's been hovering, well, not hovering, it's been stuck at 3.25 since 2006. When the Fed decided that they were going to start the quantitative easing program to sort of help the economy stabilize and recover, they lowered the rate to that point and hasn't budged since. So this was a big shift in monetary policy.
Mm-hmm.
It was big news because of that. And where does it affect you in real life? Well, if you've got a adjustable rate mortgage, it
might.
It might. It depends on where you are, in that term and what index you're tied to. Generally, the indexes seem to ebb and flow with prime rate. So if you say, "Well, I don't care about prime rate. My arm is tied to the LIBOR index," well, wait and see.
Because the LIBOR is tied to the prime somehow.
Correct. Yeah. It's all one big network. So if you're floating along on a 6-month adjustment on your interest on your mortgage, home equity line of credit, for example, you'll probably see some increase on the next adjustment period. People who are sitting on a credit card that it's not in some promotional period. It's just that's going to fluctuate with this change as well. So,
or my line of credit that's maxed out.
Yeah, exactly.
And soon to follow mortgage interest rates, wouldn't you say? In the future, the mortgage interest rates are going to see an impact.
Yeah. This will
impacted rather.
Yeah, this will come to roost here, slowly over the course of 2016. And I think an important thing that the immediate reaction to this was kind of interesting. I mean, when you basically by raising prime rate, it's going to do two things. It's going to tamp down inflation a little bit, and it's also going to theoretically slow economic growth. And economic growth slows, there's layoffs, and those are all things that generally drop rates. So, the knee-jerk reaction is this could actually positively affect rates, but that's really a short-term. You have to take a long view on stuff like this, and over the long haul, the Fed is giving control of rates back to the open market again, and ultimately, it's gonna find its way into long-term interest rates.
Dean, I have a question for you. I was reading an article earlier in the week. I was scrambling here because I know I printed it off, but then I must have left it in the printer like I do so many times. But we've got a couple of things that I have been looking at recently, talking about first-time home buyers and how difficult it is for them to get into the market. And one article was saying that most first-time home buyers are unaware that there are still zero down payment or low down payment options available to them. They're unaware of the assistance programs, down payment assistance programs, because the lending industry has just kind of stopped talking about it. Because with Dodd-Frank, and it seems to have given the lending industry and the investors cover not to talk about it, because it's easier just to push them into a standard FHA loan or something like that. One of the other things that they were talking about in there is that two things are happening. One, about the affordability index is starting to creep up now, or creep down, I guess you would say, where homes are becoming less affordable. And they're becoming less affordable for the reasons that we've just mentioned. Mortgage rates are up year over year. They're up slightly. And it looks like on the horizon they're going to continue to raise. Home prices are up.
Median sales prices are up, no question.
Median sales prices are up. Wages are stagnant or actually have gone down. median wage has actually gone down in this country under the current administration. So with all that in mind, it's making that first-time home buyer a little tougher for them to find something. And as we mentioned in the very first segment, almost 2 hours ago now, more kids then are saying, hey, I can't get a job, I'm just gonna stay in school, and how am I gonna finance it? They're borrowing money, and so the student debt numbers are off the charts. Couple that with, if you can address it, how you're viewing student loan debt now in terms of mortgage applications and qualifications.
Sure, student loans, you know, tuition has gone up, generally speaking, pretty exponentially over the last, you know, decade or so. So I think just from a sheer volume standpoint, we're seeing the biggest numbers we've ever seen on student debt load on mortgage applicants. It's shocking sometimes because you're thinking to yourself, what job are you going to get?
Right, that's going to cover that.
Yeah, and that money is still relatively cheap, I guess, in the grand scheme, but really that's been one of the largest determining factors. As far as a qualification standpoint, a lot of those loans are in deferment, and a lot of underwriters in the not so distant past have taken kind of an out of sight, out of mind approach on that.
Right.
That's not the case anymore. So if you're in deferment, what underwriters are generally wanting to see is that you get something in writing from each one of those servicers stating this is what your payment will be once it takes full effect. And that can be pretty complicated because a lot of people have a lot of separate student loan debt out there.
Right.
So I've actually worked with a few clients recently where I've actually had to help them through the student loan refinance before I even got to their mortgage refinance.
Oh, just to try to pull it all together
just
so they could
consolidate it all together, yeah, because that can really make a huge drop in your payment right there.
What are some of those rates that they're being charged on their student loans?
Well, you know, if it's a subsidized loan, if it's a portfolio loan, if they're pulling it, I mean, they're getting these loans from all sorts of different places you can imagine, but you know, generally speaking, they're still relatively low. They're not too different from what mortgage interest rates are for the most part. But pulling those together is really important, and also being able to account for what those payments are going to be, which you should be doing in the first place. You shouldn't be taking on debt without having a good understanding.
But
of
they don't.
What
I mean, the kids, all they know is they got to get through next quarter or next, the next school year. So borrow, give me the money and.
Exactly.
But when they pop out of deferment, I mean, you want to be able to make sure you're able to pay those. You're not going to get some huge jump in salary over the course of a year or two while they're in deferment.
And there's a lot of forces working for first-time home buyers, and there's a lot that are working against them. I mean, you listed off a host of things there that I could talk about. There's rates are still relatively low historically speaking, and a lot of first-time home buyers are going into government loans, FHA loans, which is a 3.5% down. VA loans, which is really still the greatest loan product out there by a long shot. I mean, no mortgage insurance, zero down. It's just a fantastic loan. USDA loans, there's zero down programs out there for that. A biggie that we're seeing is association dues. Association dues are pushing a lot of first-time home buyers right out of the market.
Right.
Yeah, for townhouses for sure. And we talked about this a couple of weeks ago. We're seeing association dues averaging $225, $250, in some cases $275, and this is for typical associations too. This isn't your condo association due that's running $400 or $500 a month, where you're getting amenities for workout facilities and pools and all these community rooms. These are just your general association where they're covering snow, lawn, what little lawn there is, sometimes water and garbage as well. So we're seeing those costs increase, no question.
But I don't want to put this up to scare off first-time home buyers, because there's a lot of things that are positives too. And one biggie that a change happened this week with FHA loans. The MIP, or the mortgage insurance premium that they charge, it dropped from 1.35% annually to 0.85.
Okay.
The FHA fluctuates all the time depending on how they're doing.
Right.
But mortgage insurance in general across the board, mortgage insurance is more affordable than it's ever been.
That's great. That's
Zillow,
great because that popped up for a period of time. The FHA increased it. Seems we were talking a lot about them pricing themselves out of the market, and now that they're probably in a good spot now with having less default on mortgages, they're able to make some adjustments to those.
And private mortgage insurance, for that matter, is coming down in price too.
Zillow has been reporting, and Zillow is awful at predicting home values, but they're very good at predicting trends. And they're saying that there's a large trend now with first-time home buyers pushing to the suburbs and moving out of the city because it's so expensive to live in the inner city in most cases. Taxes are high, transportation costs are high, living costs are higher. I mean, just everything costs more in the city. So they're seeing a lot of that first-time home buyer being pushed out to the suburbs. And then I asked myself, well, what are they buying in the suburbs? Because as we just mentioned, townhomes, which is a really good transition housing for a first-time home buyer coming out of an apartment into a townhome. It kind of feels like an apartment from a maintenance-y standpoint, but they've got home ownership and some equity growth opportunities there. But if you're looking at $250 a month dues, that's going to be a problem.
And that's more of a qualifying issue because rents are through the roof right now. So if you can qualify with those dues in there, you're probably going to be saving money monthly versus renting.
Right, a lot of folks are paying what they're paying right now on rent. They could be buying a single-family home or a townhouse.
Correct.
That's it for this week. Thanks for listening. 612-627-8000. Merry Christmas, Happy New Year. We'll see you in January. Goodbye.
You've been listening to your Real Estate Chalk Talk with the Hittner Group, the leaders of the #1 Coldwell Banker Burnett real estate team in Minnesota.